Black in the City of London.
So I'm here with Robin Pearson, and Robin Pearson is Emeritus Professor of Economic History at the University of Hull and author of Ensuring the Industrial Revolution. His interests include the field of economic and big business history. Robin, thank you for agreeing to do this.
Well, thanks for the invitation.
I wanted to ask, how did owners of slave ships obtain insurance, and from whom could they do so?
Well, in the 18th century, it was a kind of a multifaceted market, but basically there were two routes through which the owner of a slave ship could obtain insurance. Either he went to a broker, and the broker would then find appropriate people to insure the ship and its cargoes for him, or the ship owner would go straight to another merchant in his hometown, usually, or somebody he knew, and together they would put together a group of people who would underwrite the ship. Now, we think that in London, given the overwhelming domination of Lloyd's and marine insurance, that most London slave ship owners probably obtained insurance through brokers. Whereas at the outports, principally Bristol and Liverpool, and it should be said right at the beginning that London was only the major slaving port in England up until about the 1720s, and then Bristol took over, and then about 3 decades after that, it was Liverpool became the largest. So London kind of diminishes in relative importance, over time. But in the outports, it was mainly ships involved in the slave trade were mainly insured by groups of merchants, very often who knew the owner of the ship that was being insured. So it was all very much about business networks in the outports. And relatively speaking, a relatively small number of individuals insured the majority of ships. So for example, in Bristol, you might have 10 or 12 merchants who insured up to 2/3 of all slaving voyages. But there was always a long tail of smaller underwriters, people who would join an insurance policy and add their name to to increase the volume insured. And that could be up to 40, 50 additional people. They would also be other merchants, so they could be professional people like bankers or attorneys and so on. Basically anybody in that particular business community. And we know that method of insuring slave ships was replicated in France and the Netherlands as well, in the French and Dutch slave trades. It wasn't just peculiar to the provinces in England. So, yeah, but as far as London specifically is concerned, there needs to be a lot more work done, I think, on the London slave trade. We knew much more about how Bristol and Liverpool slave ship owners went about their obtaining insurance than we do about the guys in London.
So it's interesting when you talk about these relationships between the underwriters and the people who were arranging these voyages. The people who underwrote some of these voyages had experience of the slave trade or being involved in it themselves often. Obviously, these are business relationships and they'll have been forged through some common experience. Was there a propensity for people who were involved in insuring slave voyages to be involved in the slave trade in other aspects as well?
The majority of the big insurers, in other words, the relatively small number of individuals, a dozen or so in Bristol, same number in Liverpool, that smallish group that insured the majority of slave voyages, they were pretty much all involved in the slave trade. But of course, they had other trading interests as well. They also traded in the direct commodity trade, for example, from the West Indies and the American colonies to Britain. They also, as part of a business community, I've written about this in other contexts, there was a lot of other types of business relationships going on within that community of which slave ship owners were members. In other words, there was the buying and selling of property amongst each other. There were marriages between families. There were other business ventures. So, for example, some people involved in the Liverpool slave trade who were also involved in the insurance of the Liverpool slave trade also opened some of the early banks in Liverpool in the 1770s. So that's the example of sort of this sort of what I've called elsewhere collective diversification. So they may have had a core business activity, whether it be the commodity trade or the slave trade or a combination of both, but they also were heavily involved in other investing in canals and early gas works and turnpike roads and so on and so forth.
So how did these insurers Like, how did they go on to assess the risk of the voyages that they underwrote?
Well, the first thing is that, given what we've said already about the insurance being obtained through business communities, business networks, most merchants knew what they were insuring. Okay, so they knew the captains of the ships, they knew the owners that were requesting insurance, they often knew the condition of the ships. So that was a sort of a basis for quite a high level of trust between the underwriters and the merchants, because they were kind of all interlinked. It has been suggested that people at Lloyd's who were less familiar with this particular trade were at relative disadvantage, particularly when it came to insuring ships leaving Bristol and Liverpool and other outports, because they had much less information to work on, which is why probably most of the insurance of the Bristol and the Liverpool slave trades was done in Bristol and Liverpool rather than. There was some examples of merchants going to London and obtaining top-up insurance, but most of the insurance was obtained locally. How do they go about assessing risk? Well, the basic sea risks were quite well known. And the Atlantic economy was well developed by the second half of the middle of the 18th century. They knew about the trade winds, they knew about the currents. They were pretty well informed about the risks of Barbary, pirates or privateering. Risks obviously went up during wartime. Generally speaking, across all types of marine insurance, whether it's the Asian trades or the Atlantic trades, marine insurance rates doubled during wartime. So that was like a stat across the board. It wasn't anything peculiar to the slave trade. There was also quite a lot of familiarity. If you read the work of slave trade historians, like my colleague David Richardson, late colleague David Richardson, who helped me a lot with this particular piece of research, there was a lot of familiarity with conditions on the African coast. Most of the regular slave traders knew the African rulers. They knew the different conditions in the different African states. A lot of uncertainty, of course, about what a ship would find when it got to the Gold Coast or the Slave Coast. They didn't know how many ships would be there, competing to access slave cargoes. They didn't know how long it would take for cargoes to be loaded. But the underwriters, the insurers, got round some of these uncertainties by simply exempting themselves from liability. For example, the standard insurance policy written in Liverpool or Bristol on a slave voyage would usually insure the ship from its departure in England to its arrival off the coast at any particular part of off the coast of West Africa, up to 24 hours before loading slaves. And then the insurance would stop. So all the business of obtaining enslaved Africans from the coast and transporting them to the slave ship itself, which was done in yawls or small canoes, which was a highly risky venture because that was one of the riskiest parts for the slave traders. That wasn't covered by insurance at all. They exempted themselves from liability for that. But otherwise, the way the trade was insured was very similar to the way other commodity trades were insured across the Atlantic and into Asia. By the 1770s, there was a standard policy terms that were written up in the Lloyd's so-called SG, ships and goods policy, which allowed merchants to insure their ships and cargoes, A, against so-called perils of the sea, and B, against capture by pirates, captured by privateers, capture by the king's enemies. And those were the two main sources of liability which the underwriters would accept. And beyond that, they tried to exempt themselves from all other types of liability. Perils of the sea included the standard risks of sending a sailing ship to sea in those days, which was sinking, stranding, shipwreck, and fires breaking out on board ship at sea. There's the only peculiar risk. And I say our argument isn't really that it was that peculiar, but I'll come to that point in a second. The only peculiarity is you were carrying live human cargoes on the Middle Passage from Africa to the West Indies, or usually Africa to the Caribbean, sometimes to the plantation economies in the British colonies in North America. Now, how did they deal with the risks of the Middle Passage? The risks of the Middle Passage were divided up between those risks that the insurers would cover and those risks that they wouldn't cover. They wouldn't cover, I should say, what was deemed in the insurance policies as the natural death of enslaved Africans on these ships. What does natural death mean? Well, natural death means, on the face of it, what it appears to mean, which is death by old age or death by sickness or illness, but it also covered suicides, death by torture, whipping, and any other forms of brutality that were committed by slave ship crews on their captives. Those all fell under natural deaths, and they were covered. Also, under perils of the sea, what was covered by jettisoning captives overboard to save the ship. Now, this sounds like peculiar to the slave trade, but in fact, it wasn't that peculiar because enslaved Africans were consistently regarded and treated both in the law courts and in the insurance community as animate cargoes. So they were the direct equivalent of cattle or other forms of livestock like horses. So the same risks that live cattle posed on board a ship, were posed also by Africans. They could riot, they could panic, they could cause damage to the ship, they could attack the crew, and insurance treated the insurance of slave cargoes in exactly the same way as they treated the insurance of livestock on the coastal trades up and down, in the North Sea or wherever. The other aspect of the Middle Passage, of course, is shipboard insurrections or uprisings by slaves. About 1 in 10 slave ships crossing the Atlantic in the 18th century suffered revolt by Africans. Now, on the face of it, this was a big problem for underwriters. How do you insure against slave revolts? One way of exempting themselves from some of this liability was the way I mentioned already, which is that the insurance from England to Africa stopped within 24 hours of the ship arriving in Africa, and it didn't commence again until the ship departed Africa. So any revolts on board ship of slaves already loaded that were still facing the coast of Africa, still had the coastline in view, underwriters were exempt from that liability. And of course, that was a big risk because most of the slave revolts that occurred were when Africans became absolutely desperate leaving the African coast. Very often what happens is that despair sets in once the ship is in the high oceans and the risk of revolt is reduced. So we know that the revolts are concentrated around point of departure, really, or just before departure. So underwriters exempted themselves from that. But they also added a clause in consistently across all insurance policies that they said they would only be liable for losses during slave revolts, losses of slaves during slave revolts, in other words, slaves murdered, killed during uprisings, once the value of those losses exceeded 10% of the value of the entire cargo. I'll give you an example of how this worked. A Bristol ship insured for £6,000 suffers a revolt at sea, a revolt in the Middle Passage. The slaves are valued in the policy at £30 a head, which is a notional value of what an adult slave might fetch in the market in Jamaica or wherever they were heading to. So by imposing this 10% excess, essentially, in the policy, it meant that on a £6,000 policy with enslaved Africans valued at £30 a head, that meant that at least 20 slaves would have to be murdered or killed on board ship in the quelling of the revolt before the owners of the ship could claim back on the policy. And this was quite an unusually high number. 20 doesn't sound a lot, but there were a small number of insurrections on slave ships where hundreds died. But they were a really small minority. The average number of deaths in rebellions on slave ships is about 13 or 14. So to reach that threshold of 20, it meant basically that, it had to be a very serious revolt before the underwriters became liable.
Does that create perverse incentives? If you had a revolt that had 13 slaves that were murdered because they'd been involved in this, did that create a perverse incentive for captains to overstate the number of slaves that were involved in order to meet that threshold? Or is that something we cannot really tell?
Well, slaves were counted when they were loaded on board. So we know with slave traders' records record the number of slaves loaded and the number of slaves disembarked at their port of call in the West Indies. And then they usually also kept a record of how many had died. That's why we have got such good data on the slave trade. They kept a record of how many died through so-called natural causes and how many died through insurrections. The value in insurance policies of slaves per head, this notional idea of what the value of a slave was, what he or she would fetch in the market in Jamaica, was usually under the actual market value. In theory, this was possibly an incentive to kill more than was necessary to quell an insurrection. But in fact, when they did that, they were always losing money. They were losing money in every slave that was killed. And under the perils of the sea clause in insurance policies, the only justification for murdering slaves on board during an insurrection was to prevent the capture of the ship by the Africans or to prevent the ship sinking or, suffering other sort of damage. So there was always a kind of an incentive for the ship owners or the captains and the crew at least to try and keep the slaves healthy and to keep the losses down. Not least because the captains and the senior officers also, they would be given for whatever number of slaves were boarded, they would be given 1 or 2 slaves as part of their compensation packages. And the other thing that is worth mentioning, and this was demonstrated by the infamous Song affair, where live slaves were thrown overboard to supposedly save a ship, probably the worst atrocity committed by the slave trade in the 18th century in a single event. When the underwriters tried to claim for those slaves jettisoned or thrown overboard alive, they failed ultimately in their appeal to make the underwriters pay, because it was successfully argued in court in London that those slaves had not been jettisoned or thrown overboard to save the ship. The reason the ship was in trouble was because the ship had got into the doldrums in the Atlantic and was sailing around in circles, going nowhere, and water and provisions on board were getting lower and lower, and the crew and the captain was panicking, thought he had to dispose of some of his cargo to reduce the pressure on provisions, but it was all due to poor seamanship. The incompetence of the guy piloting or captaining the ship, and poor seamanship was not covered by insurance. That was one of the things that insurers were always exempted from. Slave ship captains were expected to know the trade winds and to know the routes and to recognise the islands that they were heading for, which wasn't the case in the Zong affair. So
with the Zong, it was really interesting that it had those, you had the case, then you had Grenville Sharp getting involved, then you had the appeals. So it was a protracted thing involving Mansfield, right? Was that normal? Well, clearly it wasn't normal because it was the Zong massacre. We see it in paintings and things. But how hard was it for somebody to claim? Do you know what I mean? If somebody wanted to make a claim, how would it be processed? How would it be paid? What was the time scale? What would they have to prove in normal circumstances?
It's quite a difficult question, because one thing that's consistent across the insurance industry, all forms of insurance in the 18th and 19th century, is that underwriters are very reluctant to go to court. Court brings costs, lawyers' costs and so on. They were always trying to make everything explicit in the policy, what were they liable for, what they weren't liable for, and to settle claims privately with the policyholders. So relatively few claims went as far as going to court. I mean, the Zong was a very unusual, extreme case, obviously, because it was quite common for slave ship owners to jettison their cargoes overboard, whether it be dead horses or dead Africans. But they were always dead. They were very, very concerned about contagion. In the Brazilian slave trade, the first slave below decks that showed any signs of having any sort of contagious disease was immediately killed and thrown overboard. It was quite unusual to go to court. Claims were, as far as we are aware, we don't have a lot of evidence actually on to answer your question directly, but as they seem to have been processed privately. As I said before, the underwriter would certainly have a look at the slave traders' account books and records of sales, and perhaps, if necessary, send someone to inspect any damage to the ship. If the ship was docked in Kingston or wherever, they would have somebody locally there. Lloyd's, for example, had a network of inspectors and agents across the Atlantic and in the Mediterranean by the end of the 18th century. I think for private underwriters like the merchants in Liverpool and Bristol, they would, as I say, they mostly knew the person holding the policy. They knew the reputation of the captain. They would have regular correspondence coming back from the West Indies. And so there was a lot of sources of information that underwriters could use just to test the veracity of claims. Relatively few claims were contested, certainly not in the way that the Zong claim was contested and went to the highest court in Milan.
How significant was the insuring of slavery in comparison to other businesses? And I guess, how significant was the insurance of slavery, in combination with other businesses as well?
We did some work on estimating the importance of the insurance, not just of the slave trade but also of slave-produced commodities, to marine insurance generally. We know that marine insurance grew faster than trade generally during the 18th century. For example, the West Indian trade grew by a factor of just under 2 in the second half of the 18th century, whereas British marine insurance, measured by premium volume, grew by a factor of over 4. So that suggests that a higher proportion of trade is being insured over time. We also estimated that the proportion of British marine insurance that was accounted for by the insurance of slave-produced commodities grew from about a third of British marine insurance to about 41%. So from about 33 to about 41% from the 1760s to the eve of abolition in 1807. In 1807, when the British Parliament passes the Act to abolish the slave trade in Britain, that same act also prohibited insurance of slave ships. So that basically ended that particular industry. So to cut it short, slave trading in slave-produced commodities becomes increasingly important to the marine insurance industry as a whole, particularly during the second half of the 18th century. So up to about 41% of British marine insurance was accounted for by the West Indian trade and the direct trade in slaves.
Black in the City of London.